Here?
Yeah, let's do it.
All right, and three, two, one, one, one.
Recording in progress.
Hello, everybody, and welcome back to the Beyond Wall Street podcast. I am one of your co-hosts, Nathan Bowers, and I'm here with, you know him, you love him dearly, all his infinite wisdom, talking about the infinite banking system today. Brandon Nieves, welcome back for your
All
weekly
right, thank
video.
you very much. Thank you for having me.
Always a pleasure. So, as you heard me prelude everybody, we're going over the infinite banking strategy today. And you couldn't be in better hands to be discussing that with Brandon. He's going to walk you all what that strategy is, how you can utilize it, and what it does for your money. So, without further ado, let's get started. Brandon, the floor is yours.
All right. Well, this concept, this strategy, I learned about it my second year in the industry. It was close to the end of my second year. And I found out about it through a book. And when I read it, to me, it was the missing link behind financial planning, because people have their money invested in different funds in the market. I've seen plenty of that. People have their money in bank accounts. People have their money in real estate. And the biggest problem that I saw was that a lot of people just didn't have control over these assets. One, they couldn't pull money out of this because, different stipulations and rules said, no, you can't do that until you're 59 and a half. So, and then you're very restricted on how much you can take out. So those accounts were pretty much useless to use for wealth building strategies. But that's financial planning 101. I mean, put deferred taxes into the future, use the stock market to get a competitive return, and defer taxes into the future. I mean, that's pretty much the gambit of the whole thing. Well, Americans have been doing that for so long. And yet, when you look at the statistics and the numbers, it's like what? I think it was like 73% of Americans today don't have an emergency fund. A lot of Americans are putting money away, and the reality is that Transamerica came out with a study that said most working Americans today will run out of money by age 78. So, you got 100 people approaching the age of 65, and the first 12 are forced to continue to work. 29 have passed away. Then you got about 54 that will retire with incomes between 7,000 to 45,000. Then you got only 4 out of 100 that are going to make more than $45,000 a year, and you only have 1 that's wealthy out of 100 people approaching 65. So, like, what's the problem? So when I came across the becoming your own banker, I was very intrigued by it. So becoming your own banker basically is that you accumulate an increasing pool of working capital so that you can minimize unnecessary wealth transfers. Now, what does that mean? What is a wealth transfer? Well, wealth transfer usually comes down to 5 things.
Mortgage.
Yeah, mortgage, qualified plans, that's a wealth transfer. College funding, that's a wealth transfer. Major capital purchases, anything that you can't pay for in a given month with your current cash flow is considered a major capital purchase. And then the 5th is taxes. So those are unnecessary wealth transfers, as we call it. So the idea of becoming your own financier is to do exactly what banks do.
I agree with the taxes being an unnecessary.
It's unnecessary. You got to pay it, but it's unnecessary. People are paying more than they should and don't even realize it. I mean, they just don't even think that there's an option.
Yeah.
So like the first few pages of the tax code are all about what the government is going to tax. And all the rest of the thousands of other pages are all about what you can deduct, all the advantages that you have. And if you could save money on saving money on taxes, you'll make more money saving money on taxes than trying to earn more money. Because every time you got to earn more money, for every dollar that you earn, you got to earn $1.50. But if I could save $1 from taxes, that dollar could turn into $1.75, $2, because of that compounding effect. So the banking concept was very intriguing to me because it allows an individual to make money the way banks do. I mean, it's been said that if you took all the money in the world and you dispersed it evenly between all the people in the world, in 10 years, 10% of the population will control 90% of the money. And who's the 10%? The banking sector. So now when it comes to banking, they say banking is there's three theories when it comes to banking. You have the financial intermediation theory, you have the fractional reserve banking theory, and then you also have the credit creation theory. Now, I'm not going to go into all three of those, but the one I will focus on is the fractional reserve banking theory. And so this is how it works, okay? First of all, to start a bank, you got to start with $4 million. You want to start a bank charter, you got to start with $4 million. Now, I'm not saying that you got to do the strategy, you need $4 million, but the idea is what I convey to clients is to capitalize on banking and becoming your own source of financing, you first have to start with capital. So there's a capitalization phase. You know, when you're starting a business, it doesn't become profitable right away. You got to get the business running, flowing, and then all of a sudden, boom, then it takes off. The same thing with banking. So before you could even, start lending or getting deposits from the public, you have to start with $4 million. So there's a capitalization phase. Okay, number one. Then you got to get depositors to come in and start depositing money into your account. So you got to capitalize first, build up the cash. And once you have that, okay, now you're in business. Now you just got to get people to start depositing money into your bank. And what do? You offer interest rates. So let's say a guy takes $100,000 and puts it in Bank A. Now, through fractional reserve banking, Bank A only has to put 10% of reserves of that $100,000 with the central bank. Or either with the central bank, or they hold it in hard cash. They have to hold it in hard cash because some people are going to take deposits out and they're going to take deposits out to get cash from. So the bank literally has to have cash at the bank. Okay. So for every, if it's 1,000, 10,000, I'm just using 100,000 as an example, they got to put 10% of that on reserves. So that's $10,000 they put on reserves. Now, through fractional reserve banking, they now can literally, just out of thin air, just by pressing a few buttons, they can literally now create $90,000 to lend out to somebody else based on your $100,000 deposit. And what are they giving you for your $100,000 deposit? Let's just say they're giving you 1%, which they're not doing at all, but let's just say they are. So they're giving you 1%. That's $1,000 that you're getting in interest. Now they're taking the 90,000 that was initiated by you, and now because of fractional reserve banking, they literally are increasing the money supply because this money did not come from anywhere. They created it by virtue of your deposit. So now they take the 90,000 and lend it out to Joe Schmo on the street. They charge him 5% interest on that loan, and it costs them only 1% to get 5% from this guy. So now customer B, he's got $90,000 now. So now what does he do? He takes his 90,000 and he deposited it into his account. And so now what does the bank do? Well, now they got to put 10% of that money on reserves. So they put 10% of that money on reserves of that, of the $90,000, right? That would be, $9,000. So they would do that. So they take that, they put it on reserve. So now they have that. So now by virtue of them doing that, they then have to take, after they put that reserves, they now can literally lend out $81,000 to the next customer. And what did they give you for the $90,000 deposit? They gave you 1%. So what did you get? You got $900. So far, the bank has only spent $1,900 to do this. So now they lend that money out, that $81,000, they lend that out. That guy, they charge him 5% on the spread. That guy takes the $81,000, now he puts it into his bank account, and then now the bank takes 10% of that, puts that on reserve. They give him 1%. They put that on reserve, and then then now he's got what? $72,900. So he takes that. They now literally can lend $72,900 out. They did this 3 times. I know it's a lot of numbers and craziness and all that, but think about what they just did. All they did was it cost them altogether. What's it? Well, I wrote it down. So it cost $2,710 is what it cost the bank. But the bank made actually the bank actually made $8,550. And it only cost them $2,700. That's a 315% increase in wealth. And they're doing these transactions, millions. I mean, they're doing this all day long.
They don't have to have big ones. They have so much quantity.
Right. They're doing it over and over. So now, obviously, the concept is very intriguing. So how do you become your own banker? How could somebody actually do that? Well, there's a couple things you need. So the first thing, and you're looking at this right here, the concept goes like this. You got to, first of all, this is a capitalization phase. So the strategy is a combination of savings with a new approach to major capital purchases. So now you're building up a source of finance. Now, when you have built a source of finance, you now can collateralize it. But notice that when you collateralize it, your money kept growing. It didn't stop growing. Okay? Give you an idea of how this thing works. The key is to save in an account with accessibility through collateralization, because this allows you to control more of your own money. You think about it like this. The idea is real simple. You finance everything you buy. Everything you buy, you literally finance it. You're either using credit, paying a third-party lender, and then paying them the interest, or you're using cash. You're thinking, I never use credit card. I pay cash for everything. Okay, great, that's better. But essentially what you're doing is you're just losing interest. You're just not getting any. You're still financing. You're self-financing, though. So you may not be paying interest to somebody else, but you're losing interest on what that money could have earned you had you had that money somewhere safe where it could earn compound interest, or somewhere where it could be invested. So you're either paying it or you're losing it. But one way or the other, you're not earning it. So the private reserve strategy is a way of you earning interest on your spending. When I discovered this, I said, this is the missing link in financial planning, because everybody is investing. Everybody's doing the same thing, but why do we have the same financial problems? I mean, if you think about it, look at something like this. So which is better? So now you finance everything you buy. You're either going to borrow the money or you're going to pay cash for the money. So now this is a good example of showing you, let's say you were buying a car for $30,000, the finance rate was 5%. Over a period of 5 years, your car payment is $566.14, okay? The opportunity rate is 5%. So your finance rate is 5%, and you have an account that's also earning 5%. So this is how this works. So now, if you earn 5% interest on your tank, and the lender charges you 5% on the loan, we're looking at the results over a period of 5 years. So watch this. This really caught my attention. So this is if you're financing. You're financing, the money in your account at $30,000 is still growing, but you're paying the lender the car payment. Now, at the end of that 5-year period, you actually accumulated $38,501, and you paid back to the lender $38,501. That's if you're earning the same interest rate as the finance rate. So if you're being charged 5% on a loan, and you have an account that's earning 5%. But what if you could flip it? What if you could earn a little bit more on the green tank, your account, and the finance rate is a little less? Let's say it's 5%. So now it would have costed you, the opportunity rate here would have been $4,423. What that means is, by financing the car purchase, it cost you forfeited $4,400 to do that. But now you actually were able to accumulate $38,000. Now, if it goes the other way around, it's the same thing. Now, notice if you pay cash. If you pay cash, First, with paying cash, you first got to save the money, right? You got to save up the money, the capitalization phase. So you do that, you do that for a while, and then all of a sudden, when you get to your $30,000, what do? So it's still growing, you're still earning interest, and then when you make a purchase, all the money in the tank will be gone because you are paying cash. So all this right here goes down, and you lost all your money. You're not paying interest to nobody, but you lost all your cash. So what's the idea behind this exercise? If money in your tank could earn more interest than it costs to borrow, consider the opportunity cost of draining the tank plus giving up control. Maintaining control of your money may even be worth paying a higher interest rate. If it costs more to borrow than you can earn, perhaps you should consider other tank alternatives. Paying cash is financing. It's self-financing. So what this tells you, the whole premise behind this is, what's better? Keep your cash in your bank and finance the purchase as opposed to paying cash. Because if I finance the purchase, my money is still in my control. But if I take my own cash and I make the purchase, now that money is gone forever. And your money will never be worth more than it is right now at this very moment. And the finance industry knows that. That's why they want your money today. They want you to pay interest now. We're just doing the exact same, but we're doing it on our behalf instead of doing it on the bank's behalf. To give you an idea, and this is the last slide I'll show you, is let's say you have an investment that you're looking at. Let's say the assumed rate of return on the investment is 10%. Let's lower your tax bracket to 24.
That's
Let's say the amount. What's that?
I said that's generous of you.
Let's do the amount invested. Let's say it's 100,000. Let's say the loan rate. Now, here's the thing, and I think I kind of fast forward here a little too fast. But here's the thing: the private reserve strategy is a strategy. It's not a product per se. Okay, what I mean by that is there's a lot of accounts that you can use that could play the roles of a private reserve strategy. For example, you could use a 401k. You could use HELOC. You can use a margin account. You can use a CD. You can use a money market account. You could use other accounts. The idea is there's certain criteria that you need. Number one, the account has to grow tax deferred. You must not pay any interest on or pay any taxes on the interest, because every time you do that, you're always going one step down again. So if you don't pay taxes on the interest, it triple compounds on itself. That's the first criteria. The second is you need the money to come out tax-free. So gross tax-free, it's accessible tax-free. The next thing is you need guarantees. You need guarantees that your money will not go down in value no matter what. I don't care what's going on in the economy, a recession, depression, bear market, a major correction. It doesn't matter what it is. You don't lose money for no reason whatsoever. You need a no loss provision. You need also guaranteed collateralization. You need to be instantly approved for a collateralized opportunity. You don't want to have to go through a credit check. You don't want to have to do any of that jazz. No credit checks, no nothing. You also want to have unstructured loan repayments. If you're going to talk about getting loans, you pay the loan back, but you want to do it on your terms. You have to be the owner of the account. So there's a lot of accounts that are right off the get-go you can't use. First of all, you can't use a 401k. First of all, it's not safe. It's not accessible. When the money comes out, taxable. And you can only borrow up to $50,000 of a 401k. That's it. And you have to pay that loan back within 5 years. And whatever amount of money you took out of your 401k, that money is no longer earning interest on the funds that it was invested in before you took out that loan. So that's not going to work. A savings account. Well, a savings account has some good options in there. It's safe, it's liquid, but you're getting no competitive returns, and there's no tax advantages to it. You could use a margin account with a portfolio of different stocks. You could do that. The problem is that if the stock goes down, now the brokerage company that lends you the money is going to call back those shares, and they're going to call them back at a loss to you. And they don't have to ask you for permission to do that because they lent you money. So that's a high risk scenario. So it's not safe.
Yeah.
So in order to get liquidity, safety, a competitive return, along with tax advantages, guess what, Nathan? There's only one asset on planet Earth that actually does that simultaneously. And what is it? It's a cash reserve insurance contract. It is the same asset that all these banks that we're depositing our money to, they're putting billions of dollars into these accounts.
Yep.
So when you look at it like this, when you have an insurance contract, you get immediate collateralization. So check this out. Let's say now you got money in this cash reserve insurance contract, and let's say the loan rate when you're pulling it out is 4%. The assumed growth rate, let's say the policy earns, I don't know, let's say the policy in the same year earns 8%. Okay. Now, watch this. Would it be better to pay cash or use your private reserve account? Well, let's let the numbers do the talking here. Let's look at the cash account first. So now you got $100,000 in your bank account and you got an opportunity to earn 10% on an investment. So what do? You take the $100,000 out of your bank account, you earn your 10%, and you get your $10,000. Your taxable earnings are now $10,000. So you're using a 24% tax bracket. You pay $2,400 in taxes. So you net $7,600. So reserve growth plus net total is $7,600. The tax equivalent rate of return is 10%. Well, what that means is that if you didn't have to pay any taxes, you're going to net 7.6. But if you didn't have to pay taxes, you would actually get 10%. So if you get 10%, you're netting 7.6%. So that's what you get. Now, what if you use a private reserve account? You have the same $100,000 in that account. You see the same investment opportunity, 10%. So you put your $10,000 in there. Your $4,000, though, you got to pay that $4,000 in interest to who? To the one who lent you the money. The insurance company, remember, you're not taking money out of your account. You're taking money out of their account. So they have to naturally charge interest. Do you know why they got to charge interest on that? There's two reasons why they got to charge interest on that loan. Number one, if they don't charge interest on the loan, the IRS does not see it as a loan. Therefore, it loses its tax advantages. Borrowed money is always tax-free. So the insurance company has to charge interest on the loan. The second reason is that the insurance company is taking money out of their general account. So they have to charge interest on that money to keep the integrity of the general fund for all the other policyholders. Yep. So if they don't charge interest on that loan amount, then, for the insurance company, how are they going to continue to issue out their guarantees and all their benefits to everybody else? They can't do it. So to keep the integrity of the general account, they have to charge that interest rate. So that's actually a good thing. But the other reason, so here's the other thing. So now that you see that, you pay that $4,000 in interest. So what's your taxable earnings? Your taxable earnings is $6,000. If you had your money in the bank account, it'd be 10. Here it's 6. Why is that? Because if the loan rate is 4%, and this is for an investment opportunity, you get a tax deduction on the 4%. So that $4,000 that you just paid to the insurance company in interest is tax deductible to you because it's for an investment. That just lowered your taxable threshold. So instead of paying the $2,400 in taxes, you're actually paying only $1,440 in taxes. So net investment income is $4,560, but remember, your $100,000 was still earning interest as if you never took out the $100,000. So your $100,000 that same year earned 8%. So now you earned $8,000 on top of the $4,560. Altogether, your net total, $12,560. If you used your bank account, you would net $7,600. But if you use a private reserve strategy, you would net $12,560. Tax equivalent rate of return is 16.53%. In other words, if you were to earn 16.53%, you would net 12.56. So by using the private reserve strategy, How much would you net with a bank using your bank account, traditional bank account? 7.6. Private reserve strategy, 12.56. Increase in net internal rate of return, 65.26%. And
mic drop.
Your money is working for you in two different places at the same time.
Did you like what I did there?
What was that?
You said 12.56%, and I went, mic drop.
Boom, that's it. It's over. It's over. Now, I know I went through that pretty fast, but I mean, you can you don't even have to understand it fully, but you just got to understand it a little bit. The big thing you have to understand here is that the loan interest is tax deductible to you. So that lowered the tax threshold for you. So instead of paying that $2,400 in taxes, you're only paying $1,440 in taxes.
Well, don't worry. They can rewatch it. But the point is we're doing great for our time standards, so I'm going to wrap it up. We're a little bit over. We're pushing 25, but we're going to pull it in here, Brandon. I got one question.
I'm proud of us.
I had 3, but I'm going to leave it to the number 1 question when we go to wrap this up. Who is using this strategy? 30 seconds. Who is utilizing this?
Commercial banks, they are the biggest players that use this strategy for their Tier 1 capital reserve. And what a Tier 1 capital reserve is that every bank is required to have on their balance sheet safe assets that are not correlated with the stock market at all. And the asset of choice has been cash reserve life insurance. Go figure. Why? Simple economics. The money grows without being taxed. Insurance companies are not highly leveraged, and they work off of real assets, so they're able to basically pay out a higher interest rate than a normal bank would, and the banks know that. So that's why they give all of their money for their Tier 1 capital reserves to BOLI, which is known as bank-owned life insurance. And then many wealthy individuals, Walt Disney, Ray Kroc, Pampered Chef, major presidents, a lot of these strategies are used a lot in the NBA.
John McCain,
exactly, yeah. JFK, he's another one. A lot of politicians use these types of policies, and they use it for this purpose of self-financing. But when you do it this way, you're earning interest on your spending.
Well, folks, you heard it. If they're all using it, why are you not using it? Because you didn't know about it, and now we're telling you, so what's stopping you? Skepticism? What skepticism do you have? The math's all there. There's no snake oil here, folks. It is what it is. It exists. You just didn't know about it till now. So I want to thank you again, Brandon, for coming on here and sharing the infinite banking strategy with us. Definitely going to help a lot of Americans make more money, leverage their money. Sounds like it's leveraging to me.
That's right. Leveraging on steroids.
We would like to thank you for tuning in, and if you are joining us on Twitch, make sure to hit that subscribe button. It helps us out a lot. Get the message out. Share this on Facebook if that's where you came from the link. YouTube goers, a comment, subscription on there, anything to help get the algorithm going for us, get up our viewership base. We highly appreciate it. This has been your Beyond Wall Street podcast with Nathan and Brandon, discussing the infinite banking strategy, and we will see you guys later. Thank you for tuning in.
Thank you.
Recording stopped.
Boom.
All right. Hey, our shortest one.
Like 27? 27?
Yeah.
Something like that?
Yeah.
We're getting there.
Unbelievable. Cool. Just want to make sure my math was right.